Hey guys, what's up? Alec back with the daily stock market, and look at that, NEO to $18 per share. They're going to be reporting earnings on Thursday alongside DocuSign. Other than that, we don't have much earnings going on this week, so we're going to dive into NEO and DocuSign, and then we're going to go over 3 other stocks to be watching this week in this video. So make sure you stay to the end, slap on those post notifications if you haven't already, because we're going to be talking about 5 banger stocks on this video. So jumping right in, first things first, let's talk about NEO at $18 per share. They're down 4% on Friday. And if we pull up the chart for the month, we can see from lows, they're up 42% if you were buying under $13 per share. Okay, so needless to say, I have price alerts already set at $13 per share. However, if we pull up to a 3-month chart, we see a 9% decrease over the last 3 months and a 56% decrease over the last year. And from highs, they're down around 70%. This is an unprofitable company once again, and it IPO'd at $6 per share in 2018 and went as low as $1.50 per share before rallying around 3,000% in January of 2021. Now, if you type in the daily stock market on YouTube and you scroll down to "Is this the best EV stock, not Tesla?" make sure you watch that full video after you watch this one, because it also goes over Lucid, Rivian, Li Automotive, XPEV, and also NEO. So if you need a full electric vehicle stock update, make sure you watch that video. Now, just to do a recap, we have NEO stock pulled up right now, and you can see their net income is getting a little worse quarter over quarter. However, if we pull out to the last year over year chart, we see the net income is getting a little better with a negative $4 billion. The total revenue is increasing 122% to $36 billion in 2021. And if you want to see how the income statement, the total revenue, net income compares to some of the competitors like Rivian, Lucid, and all those other ones we talked about, make sure you check out that video. I'll leave the link in the description below. Another thing to note is since 2019, they have been improving on their balance sheet. Their assets have been getting better, and their liabilities are only 54% of their assets compared to their assets. So as we can see from a valuation standpoint, NEO did get an F. You can see the price to cash flow is a 77 for NEO, while the sector medium is a 10. Price to sales forward is a 5, which is relatively high. Price to book is a 7, which is really high. Price to sales again is 5.3, and the trend continues down the chart. Okay, we'll also continue to see that NEO's delivery growth continued to decelerate in May. While no longer negative, the delivery growth rate was just 4.7, which is a disappointment. Due to continual supply chain problems, I'm adjusting my prediction for NEO's 2020 delivery possibilities, which could be bad news for earnings coming up on Thursday, and even a few earnings down the road, 1 or 2 more quarters, could be poor for NEO, according to this analyst article. We'll continue to read that NEO is scheduled to report on June 9th. Investors are waiting for management's guidance on its outlook given the massive disruption due to the China COVID lockdowns. Okay, so that's one thing to be weary of. NEO's May 2022 delivery update also show a market improvement from April's numbers. It's also highlighted robust order book visibility in May. Our price action analysts suggest a double bottom bear trap formed in NEO stock in the May sell-off. Therefore, we are confident that the bottom has occurred. We iterate a speculative buy rating on NEO stock with a near-term price target of $22 per share, which would be around a 23% upside on NEO. And if we read some final thoughts, we'll see, given NEO's disappointing factory output of just 7,000 units in May, a massively slowing delivery growth, I have adjusted my delivery estimates 2022 again, and I really have to apologize for it. I was under the impression that NEO's second quarter deliveries would see a strong rebound from suppressed deliveries in Q1 22, but the supply chain crisis and COVID-19 lockdown have done more damage to NEO's delivery possibilities than initially feared. Although there are signs of improvement, especially regarding the new model, which is E7 sedan ramp and a rebound in ES6 production in May, which is another model, NIO only managed to deliver 38,000 electric vehicles in the first 5 months of the year. For that reason, I'm forced to lower my estimates for deliveries to 115,000 and believe that the stock will continue to have trouble powering higher in the short term. Okay? So if we read what the other analysts have to say, they say, is NIO stock a buy, sell, or hold? Admittedly, our calls in NIO stock have been disappointing. We have previously omitted detailed price action analysis in NIO stock. However, we have reinstated the critical charting discipline from our previous article in our analysis. Therefore, we are confident that NIO stock has formed its bottom and investors can consider layering in. However, more conservative investors could await the potential retest of its near-term support before adding exposure. Okay, so if you're a little bit more conservative, you might want to wait till $13 per share, hit those price targets around $13 per share. If you have more risk tolerance, you can start dollar cost averaging as low as $15 per share. Our near-term price target of $22 implies a potential of 23% upside. However, we expect the stock to rally towards its intermediate resistance over the midterm. Investors who need a higher margin of safety can consider watching for a retest first. Note there's no guarantee that the retest can occur, but we think the risk versus reward profile has improved significantly given the constructive price action. Therefore, we reiterate a speculative buy rating on NIO stock. So just be careful all in all on NIO stock. There's a good chance that it could go under $15 per share again and even closer to that $13 per share. So that's where my price alerts are set. I'm not really buying before earnings. I'm waiting till after earnings is announced because I think they can go down around 10%, 20% on a bad earnings call. Next stock up that we'll talk about is DOCUSign at $84 per share, down 4.3% on the day. And if you scroll out to the last 3 months, you can see that they're down to $84 per share, down 22% in the last 3 months. And they even hit a bottom of $67 per share. And they've already rebounded up around 25% from that bottom. Okay, if we scroll out to the last year, however, we can see that they're struggling in the big picture, which is around down around 72% from all-time highs, which is an absolute disaster to say the least. They IPO'd in 2018 at $38 per share. They had a steady and consistent rise of around 100% in the span of around a year and a half. And then all of a sudden, when the pandemic happened, they went into spike mode. And just in the span of just a couple of months, okay, you can see it was only like 3-4 months, they had 130% gain and then continued to rally another 57%. So needless to say, DOCUSign has seen its explosion in growth in the past, and it's sold off all the hype. Now it's back around the price of 2018, where it was in 2018, right when it IPO'd. So let's talk about if we think that's a good deal under $100 per share and even closer to $80 per share for something like DOCUSign. So here we have DOCUSign pulled up, and you can see the total revenue is just increasing every single year for the last 5 years. So that's why it hit such an explosion in the stock price. It has an average around a 35% increase on its revenue year over year. However, if you look at the total income, you can see it's a lot different of a story, and it makes sense why DOCUSign has sold off so hard, because remember what we keep talking about, in this market that currently is going on, it does not like unprofitable companies. So really you want to steer away from the unprofitable companies right now. You want to bet against the unprofitable companies right now, and you want to start loading up on the companies that are profitable, have huge EPS numbers, have huge net profits and profitability and net income as well. We can also see that DocuSign's balance sheet is littered with debt, so they are at risk of even going out of business, even though it would be interesting to dive into their balance sheet and see where all of their liabilities are coming from. Here we see that the analysts have around a 16% upside on DocuSign, which in my opinion, the risk versus reward probably isn't worth it for a company like DocuSign, especially because that balance sheet is so risky. And as you can see, no analyst has even touched this stock in the last month or two. So that's a bad sign as well. So overall, I'm not wasting my time with something like DocuSign. Okay, I would even be considering taking out a put on them. And if I was going to be doing a put, which I'm not saying I am, but if I was, I'd be looking at something like July 22, be looking at a put. And these really don't look that good because they're pretty expensive. If you're looking at the money, you're going to be paying around $1,000, and that's a very, very risky play. However, it could print. Definitely, if you want to get it a little bit cheaper, you can look at some shorter term ones. However, they're still not much cheaper, so I'm personally going to steer away from those puts. I'm going to steer away from DocuSign. Overall, I'm steering away from DocuSign stock right now, and DocuSign would probably have to drop to around IPO prices for me to consider even buying into DocuSign. Just a quick reminder, if you're watching this video, when you wake up on the Monday morning, there's a good chance that Amazon is going to be around $120 per share. So it's going to have a 20-to-1 split. So if you want to do the math, you can take the number that the share price is right now, and you can divide it by 20. And that's how much Amazon stock will be trading for on Monday. So if you're in the close friends list, we might be doing a call option on Amazon stock once it splits. Right now, if you try to buy an option, it's going to be thousands and thousands of dollars. But once it splits, it'll be a lot cheaper. And it'll probably even be a 20th of the price. So you might even be able to get some call options on Amazon for as cheap as 50, 100, even $200 for a pretty solid option on Amazon. Okay, the next one we'll talk about is ROBLOX because it's highly requested, down to $30 per share. I think it's a great time to talk about them. They're down 10% on Friday as well. And if we scroll out to the last 3 months, down 34% and down 70% in the last year. And another disaster of a stock, down around 80 to 75% from highs. And that's just in the span of just 6 months. They're down around 75%. So they had a lot of hype building up to the metaverse, and then a huge crash, needless to say. Now, diving in, the investment thesis on ROBLOX had lost 78% of its value given the consensus downward slide since November 21, since other metaverse-related stocks, including Facebook and Matterport, have also massively declined in the last 6 months. It is apparent that the party is over for now, though the former is mainly attributed to its reduced profitability from the Apple's headwind. In addition, stock recovery will be soon. In addition, the stock's recovery will probably not be anytime soon, given its lack of profitability, which the market cares about right now extremely, the over bearish market, and global macro conditions. Nonetheless, given its massive potential in the metaverse, the ROBLOX stock remains a speculative long-term play for those with excess capital. So that kind of seems the theme of stocks recently. They're all speculative plays. A lot of them are non-profitable. You know, the market's very bearish right now, and it's these stocks that we talk about that have risks of downside are typically for people with excess capital only. Now, if we jump into ROBLOX revenues, net income gross, and net income margins, we'll see that ROBLOX reported revenues of $537 million, representing a decline of 5% quarter over quarter, and an increase of 38% year over year, which is an important number to look at year over year. Despite the year over year improvement in its gross margins from 19%, it is apparent that the company is overspending on operational expenses, given that it reported widening net losses of a negative $160 million for the quarter. It is also evident that despite ROBLOX's massive popularity, the company has yet to report profitability with negative 29% of net income margins by fiscal year quarter 2022, quarter one. ROBLOX branding partnerships However, there might be light at the end of the tunnel since some of Roblox efforts are paying off with Gucci setting up its permanent digital town on its platform. The Gucci town will feature digital shops selling unique Roblox-only collectibles such as 3D bags and garments, while also including Gucci-inspired games such as Tile Takeover and Flashlight Tag, which could be important when the metaverse comes into play if Gucci sets up their permanent location there and not something like Decentraland or the Sandbox, and they elect to go with something like Roblox over them. All right. Now we'll also see furthermore certain Web3 based items, including NFTs, will also be available on Gucci Town's virtual shelves. As a result, we may see Roblox adopted by many other luxury brands like, Louis Vuitton, for example, as part of the immersive social and world building virtual platform. All right. We'll also see Roblox profitability is not happening anytime soon. Here we have a little bit of a chart to help you visualize that. Since our last article in April 2022, Roblox growth has been downgraded by consensus estimates over the next 4 years. Its revenue is expected to grow at a compounding annual growth rate of 22%, which is actually still really good, instead of the original 28% that was expected. Since it's further downgrade from our February 2022 analysts at compounding annual growth rate of 32%, it is apparent that consensus estimates are no longer as bullish as it was on its growth prospects. In addition, Roblox projected net income profitability seemed less likely now, with a widening estimate net loss of negative 31%. Given the reality check of the current bearish market and the lower likelihood of net income profitability, we're downgrading Roblox stock to a hold for those who have yet to buy in. It is unlikely that the company will break out of the rut in the near term or intermediate term. Given that the metaverse hype train has stalled for now, even Meta has guided for lower investments for its reality labs moving forward, also known as Metaverse, given the temporary headwinds and macro issues faced by the social media and advertising giant. In addition, assuming that Roblox continues its similar underperformance in the next few quarters, we may also expect the stock further to retrace to new lows. Nonetheless, given its thriving metaverse platform, multiple future adoptions, and potentially successful aging up of its existing users, the stock could reverse its position in the long term. Thus, Roblox is suitable only for speculative investors with excess capital and overmuch patience. Overall, I agree. I think you should hold on Roblox for now. Just wait it out a little bit. And I have price alerts set around $23. I have price alerts set at $19 per share. I think that price under $20 per share, even really under $25 per share, you don't want to pass up for long-term investing, but really under $20 per share is my main goal to get my average cost under $20 per share for Roblox for long-term investing. Now make sure you subscribe with post notifications, because in the next video we're going to talk about Path at $18 per share, down 71% from its IPO. And we're also going to talk about Shopify, which is another stock that has absolutely been battered, and it's down around 70% in the past 6 to 8 months, and it's down around 80% from all-time highs. So these are great stocks to have on your watch list. We're going to dive deep into them on the next video. Comment what other stocks you want to see below, or message me on Instagram what stocks you want to see in the next video. Thank you guys for all the love and continued support on the page and the YouTube channel. Drop a thumbs up to continue to support the channel. It just takes a second out of your day. These videos take an extremely long time to make and edit down for you on my weekend, but I do it for you guys. Even if these videos just help one person have a better day or a better week or a better trading week, then these videos are worth it to me. So hit the thumbs up, subscribe with post notifications on, share with a friend if you enjoy the content, and I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.